My own experience with Lloyds is that the Chief Executive, Eric Daniels, who ran the bank up until May of 2011, was responsible for bankrupting the bank, but he banked over £20 million worth of bonuses. He and Helen Weir, the retail director, and the executive board were responsible for the promotion of the payment protection insurance contract, which the bank were found to be missold. The main problem I have with the leadership of Lloyds, and probably the other banks as well, is that the very promotion of this contract through the retail bank, which is LloydsTSB, asked the workforce to sell a contract which the majority of people knew was a flawed contract. So the workforce were being targeted and told that you will sell this contract. That to me is really corrupting the workforce. The workforce knew that this contract was flawed because the complaints were coming in. And I think that is not acceptable. It's also unlawful. The Financial Services Authority principles say that clients must be treated with honesty, with fairness, and with all transparency. And clearly this did not happen. So it's the leadership of Lloyds who must take responsibility for the way their workforce work and the way their workforce sell or missell. But nobody has asked the leadership of Lloyds to appear before a Treasury Select Committee. The Financial Services Authority haven't begun proceedings against these directors, and no wonder the British public are frustrated. It's all very well fining a bank. A bank is just a thing. People want individuals to be held responsible, and that has not happened, and it will not happen under the proposed legislation. I was recruited into the Lloyds Private Bank, and I work for the Private Bank and Wealth Division. I'm a qualified investment advisor, which means I've got the qualifications and experience to provide advice to clients who had capital of anything from £100,000 up to £4 million. And it was my job to give them advice on investment, pension planning, tax planning, the use of trusts, inheritance tax planning, all the issues that an individual would really want to know about in their financial planning. I worked in the sort of outer London area, southwest sort of suburbs of London, and into the Thames Valley area. What I found to be very, very strange was that the banks categorised clients according to their wealth. So if you were an individual, say Mr. Jones, and had up to £100,000, which to you and me is quite a lot of money, but to the bank is not, they would actually categorise you as a junior level client, and you would get a junior level advisor. If you had between £100,000 and £250,000 at the time, then you would be a sort of mid-level client, and you would get a mid-level advisor. And anything above that, you would be considered to be a wealth client, and you would get the better qualified and the better experienced advisor. Now, that is quite an easy system for the bank to be able to organise themselves around, because it's nice, tidy units, and operationally for them to run a huge sales force with millions of clients, it gives them a very convenient and manageable way of operating. But this system is grossly unfair, because the quality of the advice the junior level clients got, i.e. the poorest, when set against the quality of advice the richest, the difference was huge. The poorest clients got the most expensive products and the least qualified advisors, while the richer clients got the cheapest products and the best advisors. And if you look at the Financial Services Authority principles of fairness, integrity and transparency, it breaks all three of those principles. So when I joined Lloyds from a different background, a non-banking background, in my previous role, we didn't discriminate the clients of being poor or rich. We treated them exactly the same, and we tried to give them exactly the same advice. Now, when I joined Lloyds, obviously I joined a huge company, and I found that they had 3 different sales forces, as I previously described, And each sales force had their own sales management, their own compliance systems, their own bonus systems, which to the client was very confusing. And I came across instances where clients were manipulated by unscrupulous sales staff, who I believe were unscrupulous sales staff, to maximise charges using the three different sales systems, which I believe is unlawful. There are three case studies which I'd like to tell you about. The first case study, when I was introduced to a new branch, I was given a new branch to look after in the southwest part of London, was that I was introduced to a junior colleague who was resident in the branch, and my manager warned me that this junior colleague, who dealt with the junior level of clients, was dishonest and I should watch my back. A senior colleague of mine who is very experienced and been operating in this branch and in the area for many years also warned me that this particular junior consultant was not to be trusted. Now this should send alarm bells out, because this was a consultant who saw 4 or 5 members of the public every day. He was writing lots of business every week, regulated business. But here he was, under suspicion, and the management did nothing at all. He should have been suspended on full pay and investigated, but he wasn't. That is a very, very worrying phenomenon within a regulated bank, and it's completely unacceptable. I protested about this, and I made a particular complaint about that later. The second instance and the third instance are quite similar. When I talked about there being 3 different types of sales forces with 3 different types of advisors, in these 2 instances where clients got overcharged by £24,000 and overcharged by £64,000 in costs and taxes, it was because unscrupulous managers and unscrupulous sales consultants manipulated the clients using the sales system in place. This is unlawful, and what is particularly worrying about it was the management and the senior management knew about it and failed to stop it. I complained about it on a number of occasions, and the senior directors within Lloyds Bank have absolutely refused to properly investigate these cases.
Are you sure this wasn't a case of simple misadministration?
Absolutely not. The bank have a compliance system, which means that each time a client invests money, it goes to a compliance department to check. However, there are ways around this compliance system, and the pressure of bonuses and the pressure of targets, I believe, made these particular cases slip through the compliance system because the managers wanted to satisfy targets and hit bonuses.
So managers were deliberately mis-selling policies?
Managers were allowing their consultants to mis-sell, give inappropriate advice and mis-sell contracts, yes. Well, when I made my first formal complaint at the beginning of last year, 2010, when we were having the hearing meeting, within 20 minutes of having that hearing meeting, they stopped the meeting, says, we want to make you an offer, which points to the fact they were prepared to offer money in exchange for my dropping the complaint. I replied to this particular director. I said, I'm interested in any offer, but I want you to investigate this complaint. They subsequently denied they ever made an offer. Only later in the year, last November, did they admit that they had made offers on commercial grounds. That admittance is quite important, because they are admitting, which was in a letter, that they made offers to me for commercial reasons rather than regulatory reasons, which implicates them in an admittance that they believe their commercial interests are more important than UK law.